Let's talk about 4 oversold stocks, 4 oversold companies. Some of these companies have been completely forgotten because everybody's focused on the next Nvidia or just Nvidia or the next AI play, etc., etc. Those types of stocks, those types of companies are performing quite well, reaching new all-time highs each and every week. But the 4 companies I want to touch on in this video are close to being oversold, if not oversold already. Now, just a little FYI here, some of these companies will report their quarterly numbers in the coming days, so that might impact the stock. Now, first company I want to touch on is such a company. It's called Zscaler. Zscaler is yet to report their quarterly numbers. I believe it's tomorrow on Thursday, so we're going to cover that. But right now, this is the state of Zscaler. One share will cost you $164. The average annual price target for the next 12 months sits 48% higher than the price we're at today. Trades at a forward PE of 57.6 times, EV to sales in the next 12 months 9.9 times, and EV to EBITDA 43.6 times. If you look at the analyst estimates, what do they expect for this company in the coming fiscal year? In the coming fiscal years, sales growth above 25% year over year. EPS growth for fiscal year 2024 quite strong, 54.3% growth year over year, then followed by 17.12%, but then we see a reacceleration in fiscal year 2026 of about 25%. Year to date, the stock is down close to 26%. In the last 3 months, it's down close to 30%, so since they reported earnings 3 months ago, and it has a market cap of $24.6 billion. You can clearly see that forward PE, EV to EBITDA, price to sales, price to free cash flow, all of those metrics are much, much lower than the 5-year mean. If you needed a small reminder, this was what happened last quarter. So they beat revenue guidance. They grew 35% year over year. Calculated billings increased 27% year over year. Gross profit, $424 million with a gross profit margin of 80.8%. Operating profit margin, 19.6%. EPS increased 105% year over year to 76 cents. And free cash flow margin is at 19.2%, meaning free cash flow was $101 million for the quarter. But as you can see, free cash flow margin for the trailing 12 months sits at 26%. Dollar-based net retention rate sits at 117%. As for guidance for Q3, they expect revenue to increase 28% year over year. Calculated billings approximately 7% quarter over quarter decline. Gross margin still around 80%. Operating profit around $99 million at the midpoint. Earnings per share 64 to 65 cents. As for the full year guidance, they did increase it a little bit when it comes to revenue growth. Now it's around 31% year over year. Calculated billings got a little bump as well, between 25 to 26% year over year. With regards to earnings per share, that will come between $2.73 and $2.77 compared to $2.2 to $2.25. Now, more recently, there was a little bit of bad news that came out for the company. So apparently someone on X, formerly known as Twitter, posted that they're claiming to have potentially obtained unauthorized information from a cybersecurity company, to which Zscaler said there is an ongoing investigation we initiated immediately after learning about the claims. We take every potential threat and claim very seriously and will continue our rigorous investigation. We'll continue to investigate, monitor the situation, and provide an update. Of course, this does not look very good for a cybersecurity company when you make such statements over a post on social media. And so if we look at the stock, this report came out here May 8th, so that's that big red candle right here. But since the last earnings report, the stock has come down 30%, so it's under the 200, the 50, and the 20-day moving average, and very close to being oversold. We are now in an area where previously that was a resistance point at around $165. Back in September 2023, August 2023, and June 2023, maybe this time it will serve as a support. And of course, the earnings report will definitely tell us a bit more and the stock will react accordingly. So that's stock number 1. Of course, I will provide you an update tomorrow after they report their quarterly numbers. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so moving on to company number 2 is a company that has also not performed well this year. It's down close to 23% year over year, down over 32% in the last 3 months, has a market cap of $18.22 billion, forward PE of 14.4 times, lower than its 5-year mean. Same with EV to EBITDA, price to sales, price to free cash flow. That company is called Ulta Beauty. Yes, we're going now into the beauty direction. Why did I pick this company? Well, for one, it has been hit quite hard. That's the topic of this whole video, right? Second of all, it's a very, very good business, very well-run business. The beauty industry is going to be here for a long, long time, right? As long as women are on this planet, the beauty industry will perform quite well. And these days, it's not just the women. Anyways, as you can see here, in the last 10 years, they've retired around 25% of the shares outstanding. It's a tremendous free cash flow business. It has enough cash reserves, zero debt, and has issued a $2 billion stock buyback program. So this is basically the picture that you're getting here. A tremendously well-run company. Right now, the average analyst price target sits 32% higher than the price we're at today. If you look at the analyst estimates for fiscal year 2025, EPS growth of just 1.3% year over year, with sales growth of around 4.4%. But after that, we get a big reacceleration in the coming 2 fiscal years, top and bottom lines. We did get a little analyst update more recently. So a Piper Sandler analyst trimmed her price target on Ulta by 15% to $505 on a lower 2025 PE multiple, going from 20x to 17x. But maintain the overweight rating as the firm continues to view the stock as a buy. And of course, $505 is much higher than the price we're at today. The analyst said competition in beauty retail looks to be stepping up, which is something that the company itself acknowledged last quarter, which could be the reason for added pressure on Ulta, with e-commerce players gaining traction and mass retailers leaning further into the beauty category. While this warrants building a couple point headwind into current EPS estimates, the analyst is not overly worried. Consumers may be shifting some of their wallet to other retailers and online channels, but not all. And more recently, we've got an announcement that Ulta Beauty products are now available on the DoorDash app. This partnership marks the first time all of DoorDash monthly active users can order from a beauty retailer in all 50 states. So I guess that's another channel created for Ulta. And so looking at the graph right now for Ulta Beauty, as you can see here, RSI in the last couple of days, actually last week, we were oversold. We're now back in a better area because of 2.5 green days or so, but still far, far away from the moving averages. This was an area and still is an area where previously we did find some support where the stock and the company did rebound. That was back in October of 2023. Now the 200-day moving average sits at $455, the 50-day one at $425, and the 20-day one, which is the closest one here, at $395. Now I know, Ulta Beauty, these types of companies might not interest everyone because everybody wants to be in AI, everybody wants to be in tech and stuff like that. But I do think that they have a very, very solid business, solid compounder, and I think in the future they'll do quite well. Until they indicate something else, until they indicate continued struggle in the business, I don't see this as a loser. Moving on to the third stock. The third stock has a forward PE of 33.3 times, EV to sales 7.3 times, EV to EBITDA 24.6 times. The average analyst price target sits 20% higher than the price we're at today. And if we look at the analyst estimates for the coming fiscal years, fiscal year 2024 is going to be a weakish year with sales only growing 9.3% year over year and EPS growing around 8.6%. But then we get a reacceleration top and bottom line in the coming 2 fiscal years. Now, what company am I talking about here? Well, I'm talking about Fortinet. So we're going back into the cybersecurity space. Fortinet as well, in the last couple of years, it has been buying back their own shares. Free cash flow per share has also grown quite a lot. But year to date, the stock is basically flat. It's up 1.6%. In the last 3 months, stock is down 14.39%, has a market cap of $45.46 billion. And on all of those metrics that we've talked about, it's cheaper right now than it's lower right now than its 5-year mean. Price earnings to growth is high-ish. It's at 2.43. Now, with regards to Fortinet, we already have the latest quarterly numbers. So Unified Secure Access Service Edge is 24% of total billings in Q1 of 2024. That's up from Q4, which was 23%, and up from Q3 2023 from 20%. With regards to the performance that quarter, billings was actually a miss. It was down 6.4% year over year to reach $1.4 billion. Revenue increased 7.2% year over year to $1.35 billion. Product revenue decreased 18.3% to $408.9 million. Services revenue increased 24% to $944.4 million. And that's 70% of total revenue. But as we've seen, when it comes to free cash flow, this is a business that generates quite a lot of free cash flow, so there is no worries on that. If the stock remains cheap, that allows them to basically buy back more shares. As they say in this slide, they returned $5.3 billion to shareholders via share repurchase program since 2020, which means basically an 11.4% reduction in shares for the last 4 years. Then when it comes to Q2 and 2024 guidance, so for Q2 we have a billings guidance that was below estimates. So of course the stock got punished on that. So billings will grow year over year. The midpoint, well, not grow, it's down 1.3%. Revenue year over year growth at the midpoint 8.7%. For the full year 2024, billings to grow 1.6% at the midpoint and revenue 9.2%, which could maybe mean that in the second half of the year we could see some reacceleration. When it comes to margins, gross margin is expected to be between 76.5 to 77.5% in Q2 and operating margin of around 26.25% at the midpoint. For the full year, both of those metrics are expected to be a little bit higher. And so looking at the stock right now, RSI is of course not low, it's not oversold, but the price of the stock is not that far from where we were when RSI was extremely low. Now on the daily here, you can see that we had a little gap down after they reported earnings. It didn't really feel it yet, so we'll have to wait until we see that rebound. If we look at the moving averages, the 20-day one sits at $61, the 50-day one at $63, and basically quite the same here for the 200-day one. And so the last one here, the last one has a forward PE of 24.2 times, EV to sales 2.8 times, EV to EBITDA 10.1 times. The average analyst price target sits 30.7% higher than the price we're at today. And here as well, the analyst expectations for fiscal year 2024 is a bad year. Sales growth of just 3% year over year, EPS growth of just 4.1% year over year, but then we see a reacceleration in fiscal year 25 and 2026. And what company am I talking about? Well, it's obviously Intel. Intel is down close to 40% year to date, 26.8% in the last 3 months, has a market cap of $130 billion, and yes, repays now a dividend, has a dividend yield of 1.63%. Now, with regards to Intel, I show you here the last 10 years. So the last 10 years, forward PE, EV to EBITDA, and price to free cash flow. Well, price to free cash flow, that's in the last 12 months, so we're not getting any numbers anymore. Because while you can clearly see the moment Intel started to shift strategy, the moment Intel started to invest quite a lot and change quite a lot inside the business, this is where usually, well, we were under the 5-year mean when it comes to forward PE, EV to EBITDA. But then when they made that change, the necessary change, the change that will take some time to actually see some positive results, you can see that the stock became more expensive because the company became less and less profitable. My bet is on the fact that they are going to become more and more profitable. We're going to see that in the back half of this year. If we look at their Q1 results, Q1 revenue came in at $12.7 billion. That's up 9% year over year. Non-GAAP EPS came in at 18 cents. With regards to Outlook was again a bit weak. Revenue to come between $12.5 to $13.5 billion, with gross margin non-GAAP basis 43.5% and EPS also non-GAAP of 10 cents. If you look at a couple of segments here inside Intel, so the client computing one increased 31% year over year. That's great, $7.5 billion. Data center one only increased 5% year over year to $3 billion. My problem with that is we'll have to wait and see if they can actually convince the world that Gaudi 3 is the one to use. Hopefully they succeed because the previous versions clearly did not work out. Then network and edge that decreased 8% year over year, $1.4 billion of revenue. With regards to Intel Foundry, we now get way more information with regards to every business under Intel. So Intel Foundry, that's down 10% year over year, $4.4 billion in revenue. Altera down 58% year over year, $342 million revenue generated. Of course, we know this was going to happen. We've seen that with AMD as well. And Mobileye is also down 48% year over year to just generating $239 million. But I do want to show you this. This is the PC market share. Yes, it's true that in the last couple of years, AMD did take some market share from Intel. But more recently, in the last, let's say, couple of quarters, it's become clear that Intel is now slowly but surely regaining some market share when it comes to PC. But of course, right now, guidance outlook for Q2 is still quite disappointing. Maybe again, they're putting the bar extremely low, so it gives them some flexibility to perform better. I also stumbled on this article yesterday. So Nvidia's suspected 2025 processor is now rumored to be built by Intel using off-the-peg ARM cores. Yes, an Nvidia chip built by Intel. I mean, if this turns out to be true, if we get an official announcement, I don't know, in the next coming months or so by Intel and Nvidia, you can rest assured that Intel stock will go up quite a lot. Of course, this is just a rumor. And last thing here is something we've talked about for Intel, for AMD. This is very, very positive. For Qualcomm and Dell and everybody else as well. AI PCs forecast to compromise 65% of market by 2028, according to Morgan Stanley. I've talked about this for quite a while. The PC refresh, the next wave, is going to be quite a big one, not just because of AI PCs, but also because of Windows 12. All of that in the back half of this year. Now, Intel stock on the weekly, it's very, very close to being oversold. It's basically at the same price where it was when it was oversold. So in my opinion, around those $30 area is, in my case, a no-brainer because I am personally a shareholder of Intel. I think that if and when the turnaround does happen, of course, execution is key. This stock shouldn't be trading near $30 or $130 billion in market cap because we know that the foundry business is quite a lucrative one. And so to conclude, those are the 4 stocks, the 4 companies I wanted to cover in this video. Of course, there are probably plenty of others out there as well. Do mention those down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.